So in today we'll be sharing the Singapore 2020 outlook and some of the topics. And then lastly, I'll be sharing the technical aspect of the market. So without further ado, I'll call upon Paul, our head of research, to do the sharing. Thank you.
Okay. Yep. Thanks, Weird. I'll just move on. Yeah. We'll just give you a summarized version of our presentation. We do once every quarter. It was done on Saturday, but anyway, this is just a summary of our view on the Singapore market equity strategy for 2020. Anyway, we think there'll be 5 themes to play out for 2020. I think the first one, obviously, we'll probably morph from a trade to technology war. I think we think that Trump probably wants to consolidate his so-called trade war with China. I think with the 2020 elections coming, as you can see, his ratings isn't that great. Not to say that the Democrats have a very strong candidate, but anyway, compared to the previous two presidents, I think the ratings are still below. So we think that in conclusion, we think that it will move more towards a technology war, more be like banning Huawei, ZTE equipment and so forth, rather than further pushing this trade war. In terms of the deal that's coming up, so let's all hope that by 15 January, they'll probably sign the deal. No details are available, but you can see from what is going to happen is that they will probably want China to just double their imports. The details have not been shared, but based on interviews with Lighthouser, what he wants is to double the imports. So, for instance, let's say the second bullet point, in 2017, China imported about 128 billion of imports from the US. So what they want to do is basically double that at the minimum 200 billion by 2021 in 2 years. It's very unlikely China to do it, but at least there's something palatable that they can sell it to the US, I guess, US public when elections come around this by November. But anyway, you look at the second last bullet point in red, but there's still 2/3 of US imports still face tariffs, and the average US tariff is still up from 3 to 19%. So what this means is that the move away, the supply chain move from China to especially Southeast Asia will still continue because there are still existing tariffs even with this phase 1 trade deal. Okay, I'll move on to the second point. We think that there is actually surprising to us that looking at the data that there is a domestic recovery in Singapore. We think there's upside surprise in the Singapore economy. Firstly, you can see the construction demand is actually surging. It's actually coming close to the records of 2013, 2014. After doldrums in the last 2016, 2017, you can see that it slide. The contracts awarded slid, especially to the lows of in 2017, and has started to recover. And the other thing is, of course, the population numbers also picked up. Actually, this is mainly the non-resident population. But this is useful for us to have a more vibrant domestic economy. We need the better, higher population numbers. As you can see, it was especially weak the last 2 years ago. You can see that small bar there. Then we also see industrial production picking up. It's still negative. It's not. We're not expecting some huge surge in recovery, but there is some bottoming out, at least from the Singapore industrial production numbers and even the more recent PMI numbers. The other thing that kind of surprised us was that the foreign direct investments in Singapore actually surged to a record high, crossing the 100 billion. Although no details, we did ask the statistics department what was inside. They didn't really disclose, but I think a lot of it is probably petrochemical. Because so all these, of course, investments are good. When you have investments, it leads to better economic growth in the following years. As once you invest, then there'll be activity, there'll be output, and so forth. So that's why we think the Singapore economy could actually surprise on the upside. Of course, these are cyclical numbers. We still have our challenges. Just 2 notable ones. I think we like our working population due to our aging demographics is going to peak in 2022. So obviously, this is not good for economic growth when the number of people out there producing economic activity kind of peaks in 2022. And also, like we mentioned before, our so-called old age is like 2030. We're probably hitting like Japan levels, kind of old age kind of dependency or the mix of between the old and the young. Okay, but I know all this can be solved by immigration, but there's something to highlight. The third theme, at least, is for the next even 2020 or even 2021. We are quite bullish on the electronic sector. From the first chart on the left, you can see there is a cyclical recovery. But more important is we think there's a lot of structural tailwinds for the electronic sector. Like you can see that smartphone shipments are recovering after 3 years of decline. Is starting to recover, mainly due to the huge replacement cycle expected from 5G. The other thing is that electric vehicles is also rebounding. I think it's not only just government support, but also another one of the reasons is also the emission standards. I think especially in Europe, it's getting tighter and tighter. So you won't get a pure EV, but what you get is more like hybrids. And I think the numbers could actually will be another 1 or 2 very strong years, strong growth. And this will be positive for the electronic sector because there are more and more electronic components going into such vehicles. And of course, capex, cloud capex continues to rise. Of course, it's not as good as the 2017, 2018, but it's still growing at like probably low teens. These are numbers, the cloud capex numbers, we get it from a combination of Amazon, Facebook, Microsoft kind of capex numbers or the forecasted capex. So we use it as a proxy for cloud capex. I'll move on to, of course, the next one for the next team is, of course, political events as usual. The big one will be, of course, in the US. But firstly, before we hit the 3rd November elections, 3rd March, you probably have the Super Tuesday, where it's the Democrat Party. You probably can see who's going to lead the charge against Trump, the Democrats candidate. Obviously, the most positive for the market will be Biden, the one on the top left. I think he's also more measured in his approach to China compared to the other 2 candidates at the bottom. So that's something to watch out for. Okay, in terms of Singapore elections, the impact on the market, as you can see from this chart, it's not very clear. Some years are up, some years are down, some years are flat. So we can only conclude that not really major significant event unless there's some out of some unexpected results. But apart from that, I don't think there's any real impact on the market compared judging from the past 4 elections. Yeah, it's probably following global events rather than the domestic elections. Okay, the 5th team, I think we don't expect the kind of lower interest rate we had in 2019. If you just eyeball on the first chart, as we mentioned before, as we entered 2019, actually the market was expecting 2 interest rate hikes. But in the end, we got 3 interest rate cuts in 2019. So what we had in conclusion was a 5 interest rate swing in 5 interest rate expectations. So this is unlikely to happen in 2020. So that's why we are a bit more sanguine on our outlook for Singapore REITs. I think we had this huge tailwind this year when interest rates swung from 2 hikes to 3 cuts, and we don't think this won't happen again in 2020, and that's why we don't think the upside for REITs will not be as good as obviously 2019. It'll probably be a coupon kind of collection, coupon clipping kind of year for the Singapore REITs. Nothing much. This is just the obvious. Another reason BD had like 30 years of falling interest rates. The other chart here is just to show you that just something to monitor. Most important is the inflation rate. It's still very low below the red line, and that's why it's unlikely for the Fed to raise rates because they want the significant and also persistent higher inflation before they raise rates. So any move on interest rates probably unlikely to come due to inflation or from the Fed. Okay, I'll move on to our Phillip Absolute 10. I think when we build this from bottom up, we seem to be more telco and tech heavy, and we cut down on our financials. For this quarter, we've actually added in Fraser Centrepoint, and which Natalie will elaborate later why, and also we added StarHub. We took out SGX. I think what we see is that the data out of the derivatives data seems to be slowing down. And also we worry more of, because SGX, there's an MSCI Hong Kong Exchange is going to come out with the MSCI futures. So we just worry that some headline risk. They will eventually launch this because, when MSCI probably gave the status for China to enter the MSCI, probably one of the things is that they want this futures contract. Obviously, there's a lot of money involved in the rollout MSCI futures contract. Okay, we also took out DBS because we just think that in the banks in the very near term, there will be some headwinds because you won't get the support from higher net interest margins, and also loans growth is kind of like a bit sluggish going sideways. So that's why in the near term, we're a bit less positive on the banks. That's why we took out the DBS. The red column is just some of the performance. Yeah. Okay, move on. I think NetLink, I think no stranger. We've always liked this, just that it gives you still gives an attractive yield. and for 6%, and we just we just want the yield from this, and it's very stable, especially after after the residents, the additional subscribers they got from the closure of Starhub cable. Okay, UOB, the only among the three banks, our preference is for UOB. I think mainly because they have less exposure to what's happening in Hong Kong and also China to somewhat, but mainly because of their less exposure to Hong Kong compared to the other two banks. As you can see from the chart, their loans exposure is 16% compared to 30 to 25 for the other two banks. Okay, and they also still pay an attractive yield of 5%, and we also think that they probably will raise the dividends, probably high single digit, in line with the growth in their net profit for this year. Okay, for Starhub, this was a new addition. We're not expecting like a huge rebound in their performance, but we think that it's probably is bottoming out, in the sense that you look at some of the main problematic areas. Firstly, of course, was pay TV. Pay TV, the business, as you know, has been hit by guys like Netflix and so forth. But at least in the near term, the next 2 years, they've locked in subscribers for 2 years, number one. And they've also moved a lot of their content costs away from fixed to variable. So it makes more flexible and not so punitive for their income, especially when subscribers are coming down. So that's contained in terms of the mobile. We just think that even if TPG launch, their network will still be inferior to the incumbents, and competition has already come in even before TPG. So the market has already adjusted. As you can see from the red line, the ARPUs have already collapsed. It's not a major rebound. We just think that it's kind of bottoming out, and the yield's about 6%. So we that's why we added Starhub. In terms of Singtel, I think no change in the view. It's basically a play on the recovery in their associates. As you can see, the blue line at the bottom, there's a big jump in pricing for Airtel. Airtel is their Indian mobile arm. So after the huge fines that they faced, I think the big rebound, I think is very positive. I think it basically means that, all the operators have realized that they cannot continue with this collapse in pricing from 195, you can see from the chart, to almost 95. It's like half the prices. So that's why it's recovering, and this is positive. As you know, every increase in prices just goes down to the bottom line, more or less. The other reason why we like is also that we see a recovery in the other associates, the red line, which is basically Telkomsel, their Indian associate, which is also recovering. So for us, is we like the dividend yields, and also we think that the improvement in their regional associates. The other part is Sheng Siong. I think we continue to like this stock, not because of the so-called DigiBank by their founders, but mainly, as you can see from this chart, the year-to-date 19, you can see that year-to-date September 2019, the whole supermarket industry was flat, but Sheng Siong grew 10%. So I mean, so in a way, you can see that they're growing 10 times more, I mean, loosely speaking. And also, when we look into 2020, they're still growing their footprint by 8%. And also, we think that as some of the new stores that they had in the last 2 years mature, they will get some operating leverage as their operating expenses drop, because as you know, any new stores, they have a lot of upfront fixed costs. Okay, the other one is venture. Obviously, like we mentioned, we like the electronic sector, cyclically and also longer term. And also two other unique parts for venture is their cash levels are at record levels of 802 million. So very high chance they will raise dividends for this year. Because currently they're paying about 230 million dividends, but their operating cash flow is about 300. So even without tapping on this 800 million cash, they could raise dividends. The other reason is that if you look at the chart on the left, as you can see, the supply chain is moving out. From the first bullet point, the supply chain is shifting from China to Southeast Asia. Very hard to kind of put a figure to it, but one way we did was we saw what was happening in Malaysia. That's where Venture's largest presence in. And you can see there's a big surge in electronic investment approvals in Malaysia. We use this as a way to gauge that probably this is one of the signs that some of the supply chain is coming into Malaysia. And of course, we do meet a lot of some of those electronic companies that have office facilities in Malaysia, and they do say that their capacity is filling up, and some are even full. Some metal stampers, their capacity is full because of a lot of supply chain moving up from China into Malaysia. And of course, the yield is reasonably attractive. Yeah. Okay. Then last one is for me at least, is Propnex. I think we've always recommended this, one of the few mid caps that we took, mainly because we see that from the chart at the bottom, you see there's a recovery in property transactions. For Propnex, like any other real estate agencies, there are four parts to their business. Sorry, it's not the slide, but anyway, you got new launches, then you have HDB resale, private resale. So the of the three, one is doing badly, but the rest are doing reasonably well. So the one that's doing badly is the private resale, where the sales are down for 30-40%. So earnings growth won't be as robust as in the past, but it's recovering, and we think that the second last bullet point, you think that they will pay a yield of at least 7%, because they got a huge cash flow of 73 million, and they virtually don't need any capital expenditure or capex in the business. So we think that they will at least try to maintain a 7% yield to keep the stock attractive. And then of course the other reasons why we like them is that one of the few companies that we know that they have such a huge market share for new launches. And from the first chart you can see they've grown their market share for new primary launches from 10% to almost 50% now. Okay, I'll move on to Natalie for her thoughts on the other three stocks.
Hi, so for the next stock we have in our Absolute 10 is Escort Residence Trust. We like Escort for income stability reasons, due to the diversification, geographical diversification, as well as lease structure diversification. So the pie chart on the top left hand, you will see that the red and green parts are the income from stable sources. This is from your master leases, as well as the management contract with minimum guaranteed income. And then ART actually aims to have a 50-50 stable and growth income distribution. This is, however, currently you can see that the blue part actually accounts for 54%, which is the growth income. And this is the one that is more variable in nature, and it follows the ups and downs of the hospitality sector or the performance of the assets. The second pie chart is actually the breakdown via geographically, and then one of the reasons why we like the geographical diversification is due to in the first half of 2019, for example, we can see that some geographies like UK and China, UK and Japan did better than, and the better performance actually helped to offset the weaker performance or the more competitive situations in China, while ART actually managed to outperform some of the more Singapore-focused REITs. So this geographical diversification actually helped ART outperform their Singapore pure play peers. The second reason why we like ART is due to their very substantial debt headroom of 1 billion Singapore dollars, as well as their ROFR pipeline of 20 assets. So this very substantial debt headroom actually, if they were to utilize it, it will bring their gearing up to 45%, and it will increase their DPU by around 40%. And it will also increase their DPU yield from 5.4% to 7.5%. So it's very substantial should ART decide to actually acquire more assets. So our third reason for liking ART is tied to their sponsor, which is the Escort Limited, a wholly owned subsidiary of CapitaLand. So the Escort Limited, they are actively trying to grow the number of keys under management. So they have grown the number of keys under management from 40,000 to 100,000 over 4 years. So a CAGR of about 36%. What actually happens is that they go out and get management contracts where they help to brand and run accommodation or hotels. They will brand it under Escort, Citadines, and Somerset. Of this 100,000 keys that are under management contract, actually only 50% of them are currently operational. So we still have another 50% that will come onto the market. And what this does is that it will increase the more number of accommodations and hotels that have the Escort branding. It will benefit ART in the sense that they are part of an ecosystem where there is member loyalty, and members of the Star program, which is Escort's loyalty program, will be able to select some of ART's residences or accommodations as well. So the Escort Limited is also intending to grow the number of keys under management by 60% in the next 5 years. So with that, we have our accumulate call on ART. Moving on to Fraser's Centrepoint Trust, we like Fraser's due to the resident necessity spending and the outperformance of fringe rents in comparison to the central rents. There are two ways of growth that REITs can experience. First of all is the organic growth, which is increasing better performance of their existing assets. So in the catchment areas where three of their largest malls are, which are Causeway Point, North Point, and Waterway Point, the projected number of HDBs the number of HDBs in these catchment areas are projected to increase by about 67%. And what this actually brings with it is an increased footfall, as well as the tenant sales that comes with the footfall. And it will actually help to increase the turnover rent that Fraser Centrepoint Trust will be able to command. And we like Fraser Centrepoint Trust for this organic growth. Not to mention that two of the malls, which are Causeway Point at Woodlands and Waterway Point at Punggol, they are beneficiaries of the URA master plan. So that will also bring more footfall to the malls. So another way of Fraser's FCT also has inorganic growth in store. They have a pipeline of 3 assets from their sponsor, as well as 6 Singapore assets from this private fund that they are invested in, which is called PGIM ARF. Together with their sponsor, FCT has been acquiring a substantial stake in this private fund with the idea of eventually getting control of it and acquiring some of the assets from the fund. And currently, FCT as well as Fraser's Property Limited, they have a majority stake in the fund already. So we actually expect them to be able to acquire some of the assets soon. So we reiterate our accumulate call on FCT, and we move on to our last compter for our Absolute 10, which is CapitaLand. So post acquisition of Ascender Singbridge, the AUM actually increased for CapitaLand, and one of the reasons in favor of the acquisition of Ascender Singbridge is actually for CapitaLand to be able to get exposure in different new verticals and new asset classes. So currently, CapitaLand is actually focusing on unlocking this value from the acquisition. The new geography that CapitaLand was able to and wanted to acquire Ascender Singbridge for and gain presence in is India, which is a market that they were previously not very successful in penetrating, as well as the business parks. So CapitaLand has great plans to actually improve on the development of these in these areas, namely India as well as the business parks in Singapore. Another reason why we like CapitaLand is due to the very substantial recurring income. So about 83% of the 3Q 2019 EBIT was actually from recurring sources. So these recurring sources actually comes from fees charged for the management of private vehicles, as well as the REITs, and as well as the management contract income that is earned from the Escort Limited. CapitaLand actually intends to increase the amount of AUM from 72 billion to about 100 billion, and this is a CAGR of about 8.5% over 4 years. So together with the increasing of the AUM via REITs and private vehicles, and the increasing of the number of management contracts from under the Escort Limited, the base of recurring income is projected to grow steadily over the next 4 to 5 years, and this will give more stability and income visibility from recurring income, and help to offset any of the more volatile and lumpy development incomes. So with that, I'll move on to Wei Ren for his technical views.
Thank you, Natalie. So move on to the technical strategies. For the technical strategies, let's do a recap on the 2019 STI. So basically, price rebound above the 3,100 in Jan last year, and it had a very strong bullish run up to 3,004, which is a 300 plus point increase in the in Q2 2019, which is in May. However, but Subsequently, price did not manage to close above 3,004. Instead, it had a strong rejection downwards, which we see price retreating to 3,100 back to the psychological support on the second half of Q2 2019. So subsequently, it did have recovered, but it's still kept at 3,386, 14 points short of the 2019 high. So from a technical perspective, the 2019 momentum is still currently in a prolonged corrective phase. And based on the analysis, it indicate that the prolonged corrective phase will be likely to continue into 2020 and 2021, which will be capped between 2009 and 3006. So I move on. So based on the monthly chart for the past 12 years, SDI did not do very well. So from the high of 3,831, it had a fall to back to 1,455 during the Great Recession. So although it did make a recovery in Q2 2009 after the Federal Reserve introduced a TARP program, but price still remained below 3,700. In fact, it didn't even break. The highest point that SDI reached in this past years is near 3,006. Which is quite impossible. The recovery is quite weak. So if you look at the chart, Fibonacci retracement shows that price has been rejected at 78.6, 88.6 after the price rebounded at 50% of the range, which is, if you are familiar with the classic price action pattern, is actually a double bottom. So the double bottom, actually, to confirm it, it has to break the new high, preferably above 3,009. But sadly to say, price retreat at the last one was 3,006. Is at 80. It had a dark cloud cover at 88.6% of the Fibonacci range. So I move on to the weekly chart, the monthly chart. Sorry, it shows a very strong regular flat corrective wave with no super cycle of the classic 5-wave impulse wave of the Elliott wave action. So we believe that there are still short bursts of momentum, but however, the money cloud indicate that there will be a bearish action. Why? Because on the once the B wave completed at near 3,005 or perhaps at 3,008, there will be a strong correction down to 1,005 again. I'll move on to the weekly chart. The weekly chart, we have completed a 5-wave in the intermediate phase. So therefore, we believe that that now we are in a corrective phase, but this time around, the corrective phase will be a very interesting one. First, we have a symmetrical triangle in a corrective pattern. We are now on the way to complete the wave 4. So through the price action and through the wave analysis, we have a limited upside. Basically, we believe that after wave 4 is completed, the minor demand area highlighted in the blue color area in the chart in the region that shows a strong desire, demand, and buying area. We shall have a stage of rally to break out above the supply area, which is around 3,004 to 3,003. And then after that, you will have a subsequent correction and then back. And then you just have to break out above and then reach 3,006. However, this time around, the symmetrical triangle or the pennant, which some of you may see it, will be actually the rally and the breakout will be actually capped at below 3,006. Or perhaps if we break 3,006, then the price may go up to 3,007. But which I think that our possibility is quite limited. So I move on. So we have a top 2 stocks that we would like to share. So first, CapitaLand is growing very strong. First is that in the first day of the trading day in 2020, second, which is 2nd of Jan, CapitaLand has a strong breakout of the ascending triangle. And it actually have a strong breakout of the 161.8% target of between 2.98 to 3.45. So the breakout will most likely go to the 2% target retracement extension level at 3.93 to $4, which is the resistance zone highlighted. So we believe that even though there's a resistance zone, we believe that after a correction, there will be a rebound going to 4.12, even to $4.30. So let's move on. Lastly, we will be sharing about Venture Corp. Venture Corp is although there's a great sell-off back in 2018 Q1. However, there's a falling wedge, and based on the wave analysis, we believe that there will be a strong up move in the years to come. Give you a period of 2 to 3 years, and then subsequently, we are aiming a target for a long-term target of $37.34. So for the whole research team have a conclusion on bullish for 2019, 3,700 for SDR target, global upside surprise, which is quite surprising. So main focus will be this year, team will be telco and technological sector, and possible for relating catalysts. So moving forward, we will be having the webinar on a bi-weekly basis in 2020. So unless there will be a further notice. So with that, is there any questions so far?
Yeah. Okay. We got a couple of questions. We'll just try to try to answer some of them. Sorry, bullish for 2020 or 2020 is right. I think yeah. Apologies if there was some misunderstanding there. Yeah. Then are you able to give your views on the digital bank license and what you should look out for? I think I mean for the digital bank, just a couple of views, a couple of points. I think from us at least, firstly, the path to profit for digital bank is not so easy. I think the only way you can, not say the only, the two clear ways to make money if you're a digital bank is either you lend money or you help transfer money around. I think these are, even the DBS CEO Piyush also mentioned that there are no other really clear other alternatives of making significant sums if you're a digital bank. So if that's the only two ways, so we think that the digital bank, the impact will more very niche rather than any really meaningful impact on the banks. There's also going to be huge customer acquisition costs. I mean, firstly, you got to try and get the deposits from the customers. I'm not sure how many people want to, I mean, you can put a certain portion of your money with some of these new digital banks, but I'm not sure if the trust and recognition is enough for people to put the significant sums of money compared to the other three banks. And then secondly, the other three banks are also investing a lot in technology and competing against these digital banks. So if there is an impact, it would be, at this point in time, it will not be significant. It's more on the very niche segment. And the third part is, I think digital bank probably more applicable in the emerging countries where the technology, where the competitors, like where the incumbent banks are not so strong in technology, or where the size of the landmass, like something like Myanmar, where the country is so huge, very hard to meet the needs of all the countries. So digital has a greater value. Whereas Singapore is so small and it's really so well penetrated, and also the technology for the three banks are also very strong. So I think the profit pool for these digital banks or the penetration would not be so significant. In terms of another question we had was, to recap your position 2020, why is the healthcare sector taken out from your recommendation? I don't think it was put in the first place. I think we do have a full slide deck, which is for by sector, so we didn't show that. But anyway, for healthcare, we are kind of neutral. I think and the main one is only going to be the Raffles Medical, and I think it's very matured in terms of hospitality, in terms of the healthcare sector in Singapore. When we look at the numbers, the two headwinds that we mentioned before for the healthcare in Singapore, at least for hospitals, is the slower foreign tourists and also competition from the public sector. We don't have the slide here, but you can see that in the last 4 to 5 years, public sector was literally, losing share, lack of better word, losing share in the patient loads to private sector hospitals. But the data has turned around, and right now, because the public sector has responded with many more new hospitals, so that's why they're losing out. So Raffles Medical is more a wait and see, depending how well they do with their 2 new hospitals in China. which probably going to be losing money in the next 1 or 2 years. So that's why it's more like a wait and see for Raffles Medical. But we never really recommended much on healthcare. It was more neutral than anything else. In terms of the last question we have, for the autonomous vehicle, which telco engineering company have good position in Singapore? I think first thing very important to differentiate. I think when we say EV, it's not really autonomous. I don't think autonomous, if you're lucky, you get it in 10 years. Autonomous has a lot of challenges. You want to do autonomous, other cars also have to be autonomous because there's a lot of vehicle to vehicle communication. Number one, and number two, you want to do autonomous, you really need 5G everywhere. You can't have like certain parts of the country don't have 5G and the car will probably just crash. So it's not so much autonomous for us, it's more electric vehicles. In terms of exposure, really hard. I don't think to play this sector, you get much exposure in Singapore. It probably be from the other countries. Yeah, sorry, it's probably not Singtel or ST engineering. For electronic vehicles, for EV, if you must, it's probably going to be someone like Infineon. There's a huge exposure to EV components because the electronics in cars is not just electric vehicles. As you know, all the cars these days got, your electronic seats, LED lights, drive assist function, and so forth. So even before you get into EV, there's more and more infotainment, there's more and more electronic components going into EV. So that's why it will benefit maybe someone like Infineon and so forth. Yeah, thanks.
Okay, thanks. You're welcome, Mr. Chan. Thank you. Okay, so if there's no other further question, we'll end off the webinar today. And I'll take the chance. I'd like to take the chance to wish all of the attendees a very happy and prosperous New Year in 2020. So I'll see you all back in 2 weeks' time before the Chinese New Year. Okay, thank you very much. Have a good day. Bye.